Good afternoon, everyone. How are we doing after lunch today? Good, bad? If not tired? All right, okay. Well, hopefully we can get some more enjoyment, more energy in the space. I mean, we've got a stellar panel for you today. Sorry, I'm struggling already. But we'll sort of jump straight into it with quick introductions, and then we'll unpack a little bit about what this topic actually entails. So, bit about me. I'm one of the co-founders at Drift. Well, with the largest perpetual DEX on Solana right now, done about 10 billion in volume since our launch. So that's just me. Panelists, Tascha, maybe starting with you. Just a quick 30-second on a bit about you and what you're doing.
Sure. So co-founder and CEO of Alpha Finance and Stella. We started building since 2020 in DeFi, particularly in leverage. And we can talk more about what we think of leverage in the bear market now as well. But the main product that we built is leverage farming and leverage LP. On all chains, so mainly EVM, Ethereum, Optimism, Arbitrum, Avalanche, Phantom. The highest TVL or total usage was around $2 billion. And now we're scaling that to more sustainable and also for the next bull market for a new way of leverage. So now building under Stella.
Excellent. Tien?
Yeah, so I'm Tien, CEO, co-founder of Pendle. So Pendle is yield tokenization and trading protocol. And among the use cases that the protocol enables, firstly, it's fixed yield. We're currently the largest protocol on DeFi that enables fixed yield. And then there's yield speculation, primarily for traders to express a view on assets APY.
And last but not least, Smokey, please.
Yeah. Hey guys, my name is Smokey, the Bera of Berachain, as might be a little bit evident. I run an EVM-compatible L1 built on the Cosmos SDK and powered by proof of liquidity, which effectively allows us to rehypothecate liquidity as a form of security to power core applications and smart contracts building on the chain, such that the validators on Berachain utilize state capital to power the applications building on top of them.
Excellent. Thanks, panelists, for the quick introduction. So we'll dive into this topic. So the topic today being new frontier of DeFi economics. So maybe I'll flip it around, Smokey, starting with you. And you're a base chain. How do you guys think about 0 to 1 as one of the newer players in the market, and what does that mean for you?
Yeah, for us, I think that it's interesting because we see DeFi ecosystems evolve in a number of different ways. They often revolve around one major super app. And I think for the last few years, we've seen this thesis play out where people try to solve a blockchain scaling trilemma or a blockchain trilemma in general and look towards decentralization, security, scalability, et cetera. But I think more than anything else, people are just chasing a hot ball of liquidity and users. So really the way that we've thought about this and the way that I think Berachain is engineered with this purpose in mind is actually to build around liquidity as a core primitive and have that feed into as much of DeFi as possible. So our thesis is that if you build liquidity, say aggregation and accumulation into the base plate of the chain, and allow the apps and let's say the applications building on top of it to actually draw on that and have a meaningful reason to exist there, then that's how you start the ecosystem off the ground. I think you need a good combination of activation energy, unique apps that can be a base plate, so think like GMX and Arbitrum, and I'd say just new builders to get that off the ground. But it's a multifaceted approach at the end of the day.
No, absolutely agree. I think if we wind back about a year and a half, 2 years, when we think about GMX and what that did for Arbitrum, still to today, GMX has approximately 35 to 45% market dominance, and it just goes to show how much a single application can bring to a chain. I think that sort of brings me to the two of you, Tia and Tascha, both of you building applications of DeFi and quite different in some regards. Maybe Tien, I know we've known each other for a while. There was a time where Pendle TVL was closer to 5 million. Now it's close to 125. So this is a massive increase, 25x, if not more. Tell me, how did the change in economics work for you? What did you guys do differently to really ramp that up? Because I think it's one of the fastest growing protocols for 2023.
So we actually spent a good part of last year revamping the protocol. So at the product layer, there had been quite a substantial change at the AMM layer, and also just how certain yields are stacked. Beyond that, it was a lot of experiments with narratives. So to a large extent, we have been a great beneficiary of the LSDFi movement in the first half of this year. And then that was when I think we started to see a more gradual increase, and then eventually became more exponential in a relatively short span of time. Because what Pendle enabled for LSDFi at that point in time was a venue for speculators to express a view. This was before Chapella fork, and before Chapella fork, there are a lot of, people have maybe divided views, right? Whether post Chapella fork, will there be more deposits or less deposit? And if you have either of these views, what can you do in order to generate wealth? So we became the venue for asset deposits and also for yield speculation. So I think that became a pretty good use case for Pendle, and then we started to see more deposits. And then gradually we also expanded the focus to other verticals of assets. So beyond just ETH LSDs, we also have strong emphasis on perp protocols. So we have definitely benefited from the growth of GMX and Gains network. And yeah, again, similarly, right? Because the yields for these protocols are very, very volatile. And then we provide a venue for users to speculate. More recently, I think we're taking a keen interest on real-world assets. So along the way, we're just mostly identifying narratives that we think would make sense, and then associate the Pendle brand to these narratives and stay relevant.
Absolutely. And Tascha, I know in a previous product that you built, I think you really took the leverage products to the market. And I guess in a similar vein, how have you done that for Stellar?
Yeah, I think the one thing to realize is that a lot of people think, in the bear market, there's not much demand for leverage, which is true. I think a lot of the on-chain usage now is also very minimal, let alone leverage alone, right? But I think it's very important to also note that leverage is very bread and butter to any financial system, because that's how you actually maximize the capital efficiency. So I think the way we're actually positioned still for the next wave of cycle of DeFi is that we need to identify what's actually echo TN. We need to identify what's the tokens or the assets that people will be mainly holding or trading, right? Because if you actually went back to 2020, a lot of the tokens were all governance tokens, right? So different governance tokens, a bit of major tokens like BTC, ETH, stables, but because of majority of the tokens are governance tokens, and that's how a lot of new members get onboarded, then that's where the initial leverage yield farming came to place. So if we take a view that the next wave of new capital is going to flow in through RWAs or real world assets, then you have to imagine what are the different leverage angles that actually make sense to enable even more yields on these RWAs, but in a different way than just leverage farming, then different way from just leverage LPing, because that only works for governance tokens in which the yields are super high, right? But RWAs, the yields are quite low because the yields are sustainable and from the real world. So we have to kind of combine, I would say, DeFi economics to more of a fundamental and really like long-term sustainable view of RWAs, and then enable that through leverage.
Absolutely. And do you think that's something that's driven by market cycle? Because I do recall there was a period where like the higher the number, the better the product, or the higher the adoption. I feel like as of 2023, people are getting more cautious around what they're jumping into. They're aping a lot less. They're thinking about sustainability. So how do you evaluate that based on market cycle, if you think that's relevant?
Yeah, I think a lot of the times when you're in that moment, you actually don't know whether what's sustainable, what's not. And it was funny because back in 2020, I recall a lot of people think 4-digit yield is sustainable. But I think with the current bear market, a lot of the setbacks that we have shift the mindset quite a lot. So I think now a lot of people anchor more on different stables or even different RWAs. So I think the key thing to see what's actually sustainable or not is to come back to the real world and imagine, okay, if this is going to be in real world, would it make sense? And maybe you can add some degen multiplier to it to a certain extent, but not like 100x like in 2020. And I think that's like my range of like what I view of sustainability. For sure, you cannot go full stream, anchor everything to the real world and then go with the pace of the real world, because it's going to be too slow for crypto and too slow for DeFi.
Absolutely.
Yeah.
I know, Tian, we talked a little bit about real world assets entering Pendle. How do you think about that as a newish asset class. I think it's been a hot topic for 2023. How have real-world assets interacted with the existing suite of products that you have?
So from our view, we are very bullish on real-world assets. Again, because I think in this current climate, there's a lot more emphasis on sustainability of yields. And so far, I think, at least prior to this current cycle, the yields were largely driven by emissions. And then when token prices collapse, the APYs also went down, and then a lot of money just went away. And then I think the people who are still staying in the space are a lot more wary of that, and then looking for assets that could give meaningful and sustainable yields. So right now we're seeing T-bills mostly getting tokenized, and then starting to see increasing TVL. So if I remember correctly, in July, there was probably a little less than $1 billion in TVL for real-world asset, but by now, across all the different kind of assets, including gold, precious metals, T-bills, it's already $3.5 billion. So there is a steady inflow of liquidity from off-chain to on-chain, and getting tokenized through all these different like crypto means. And I think, personally, I think this is it's probably the start, because the start is relatively slow, but I think in a relatively short span of time, that inflow will probably compound and grow exponentially. And then this is where, with more liquidity on chain, protocols can get creative and try to build on top of the yield. I mean, right now for T-bill tokens, it's probably offering around like 5% APY. So of course, like if you and just given the composability nature of DeFi, there are many ways that you can mix and match T-bill yield and then LSDFi yield and maybe something else and package it, and the effective APY could become as high as 20% or more, right? So I think that will probably eventually play out. And from a Pendle standpoint, right now, because of our position on, because of our view on RWAs, we're starting to support T-bill derivatives of T-bill tokens like SDAI and FUSDC, and then gradually we want to explore how else we can increase the number of assets listed on Pendle, and then allow for yield speculation and more means and strategies for wealth generation.
Absolutely. So you mentioned some of the USDC variants, and I know something that's also, I think, based in Singapore potentially, Athena has been a big talk of the town in terms of how it's generating essentially cash rates by just holding it. Any thoughts on that? And open to all the panelists here for, I guess, a new style of stablecoin, if you may.
I don't have too much of a view on that at the moment. Yeah, probably need to study more on it.
But I think talking about stablecoins, I feel like we're still going through like experimentation phase, even though it's been many years of experimentation. But we still haven't break through anchoring everything to centralized. Like the main USDs on chain now are still USDT and USDC. Even though we have more RWAs coming, and there are like different protocols that are doing stablecoins backed by RWAs on chain. For example, T protocol, like it solves the problem in another angle, but it still comes back to centralization. So I feel like a lot of the experiments still have to go a long way, and I think also depends on the the legal landscape as well, because that alone kind of sets a lot of the projects away from continuing to develop, or having to anchor back to centralize, like the Frax token. Yeah.
No, absolutely. And I guess, Smokey, for you, when you think about bringing those projects for that 0 to 1, what are some of the core focuses you think about when scaling up this DeFi ecosystem on Berachain?
Yeah, that's a great question, man. I think for us, we've seen very standard things across a number of different ecos, right? You always have a DEX, you always have a lending market, you always have perps. I think that what we need more than anything else is the next generation of primitives, and I don't think that's a hot take. I think we've all been saying we need a next generation of primitives forever. And it's rather, what does that actually look like? Is it stuff like what Tien's doing around, interest rate derivatives, which I think have a massive future on chain? Is it stuff like, bringing credit default swaps on chain, which is, being done by a protocol building with us that I'm super excited about? Is it the recapitulation of a TradFi world on chain, or is it actually leaning into the composability and some of the stuff that we discussed earlier, like with T-bills and RWAs, et cetera? I do think that you have to take a multi-pronged approach, and I think that you can't just dial in on one area, but it's probably important to be T-shaped. I'm probably most interested in broadly what could look like the space around exotic derivatives, new types of options, new types of risk tranching in terms of collateral when you come to lending markets or perps. But I also think there's another meta that could evolve very quickly in the next little while, sort of with the rise of account abstraction and sort of the the ERC 6551 standard. And I could see a very cool world emerging around basically whole account collateral. Because when you think about the reasons that people choose to take an action on-chain versus off-chain, right? Why one would buy T-bills on-chain versus just buying them in your bank, right? Or why one would choose to take leverage on-chain versus going out and taking an LLC, et cetera. In most cases, it's ease of use. In other cases, it's easy access to leverage. In other cases, it's just a click away. So I think a world in which one could tokenize or effectively have their entire account as a smart contract, and then basically take leverage against that gets very interesting, especially when you feed it into other protocols. So I think we could see a whole world emerging around whole account collateral. So to answer your question straight up, I think it has to be new things because people are tired, and there's no reason to bridge to a new chain, explore a new ecosystem if there aren't new things to look at. I think that it's been interesting to see that from a non-DeFi but almost a social-fi point of view on Base and sort of what that's looked like with friend tech and the explosion of new accounts and 135K users coming in from that. And I'd like to see DeFi primitives achieve that in ecosystems like Berachain down the road.
Absolutely. So one thing that's been discussed so far on this panel has been this shift towards RWAs. In a previous cycle, there was a big emphasis on governance tokens that Tascha mentioned, leveraging them up. So with that in mind, do you guys have any thoughts on how native tokens play into economics moving forward? Before we had these giant emissions that took the form of liquidity mining that was, I think, the progenitor being Compound, and then there were a lot of these food tokens that took place, and that's that 4-digit APY was considered sustainable. But that seems to have changed quite significantly now. So how do governance tokens, if at all, play into DeFi economics in this current time?
I can start. I feel like DeFi token itself, or governance tokens, I see that as a tool, right? So this one tool is actually very useful for a different stage of the product or like a project. So let's say when you're starting out, you can starting out the product, you can use this tool to incentivize. Later on, backtrack to 2020, people only use that tool to incentivize, and that's it, right? But I think what we have to do now is change application of the tool to make it such that you can capitalize and make it sustainable. So hence now we see different way of tokenomics, for example, VE tokens or ES token. So I think people are exploring more on like, okay, we have incentivized the product through this tool of token. How do we use this tool again to kind of capture it and make it more sustainable? And then once you kind of maintain that growth, then to a certain point you can unlock the community engagement through governance. So I feel like all three things that you mentioned are very on point in terms of incentives and like capturing the value more sustainably, and also governance. But a lot of the times people only do one thing and that's it, right? For the tool, you have to kind of do all the applications, but maybe at different time. Because if you unlock the governance to be so early when your community is not super active, it's also going to be a waste of your time to drive on that as well.
Certainly.
Yeah.
And speaking of, I guess, the VE model, I know Pendle is a thing. Maybe, Tien, if you could share with the audience a quick summary of what Pendle is and how it operates within your ecosystem.
So Pendle is our implementation of the VE token model. Basically, when a user locks up Pendle from between the duration of 1 week and 2 years, they get Pendle. And Pendle has three functions, right? One is as a yield booster, specifically for liquidity providers. Secondly, it functions as a voting right for incentive channeling, because every week there is a budget of liquidity incentives that can be distributed to the various pools. So this is where I think there's an alignment of interest between the voters and the liquidity providers, because if they have a position and a stake in a certain liquidity pool, they are more incentivized to vote for incentives to be directed to the pool that they have a position in. And then thirdly, after voting, there is also the V token, V Pendle functions as a means to claim protocol revenue, because protocol generates some revenue, and then after voting, there's a voter APY. Again, this is mostly to align interests. So pertaining to your questions related to whether token plays a part in the economics, I think it definitely does, especially in the earlier stage, right? It helps a lot with liquidity bootstrapping, especially for DeFi protocols, because without liquidity, trading and any kind of activities wouldn't make a lot of sense. Like say AMM, for example, without liquidity, there's no like trading is a lot harder to take place, and the trading experience will not be good, and then people wouldn't come. But with the token in place, there is an incentive for liquidity providers to provide liquidity, and then whoever wants to trade token can trade with better trading experience. But of course, I think just bootstrapping liquidity is probably a subset of that. I think more importantly, from a protocol token issuer standpoint, it's about thinking, it's probably more important to think about the utility. So again, like beyond just like VE, there are probably other token models, but ultimately it has to have a purpose, because otherwise, if there's no reason to hold on to the tokens, after farming the tokens, by becoming a liquidity provider, the next natural step is really to monetize the protocol token, right? So selling it at secondary markets to realize the yield for liquidity provision. So this is what I think a lot of other protocol tokens that do not have very concrete token models suffer from. And for a large part of like Pendle in V1, that was how we were. So with the launch of Pendle V2, we incorporated the learnings and the observations of token designs into the entire construct of VE Pendle. And I think to a large extent, it has helped accelerate the growth.
I think absolutely. I mean, the results speak for themselves. And when I look at a lot of tokens of perpetuals exchanges, I mean, perpetuals exchanges are a happy marriage of derivatives and also crypto, which for regulators not too great. But with that said, when you think of these exchange tokens, be it Uniswap, DYDX, these are essentially vanilla governance tokens that accrue no value, but somehow still maintain very large FDVs. For the panelists, do you have any thoughts on these governance tokens that, at face value don't have much value accrual? I think we're starting to see things change with DYDX moving to V4 and their whole validator setup, and then as such the token becomes quite useful in staking. But prior to that, all these governance tokens were just there for the purposes of being a token. So maybe Smokey, I know something you might want to jump in on here.
Yeah, I definitely have thoughts on this because Berachain has a sort of funky governance structure. As a very quick high level, the only way to gain the governance token of the chain, BGT, which is also the staking token of the network, is by providing liquidity to a set of DeFi primitives that are built into the chain. So you can't just market buy BGT, you effectively have to do the work of providing liquidity on the DEX, the perps vault, the lending market, or the stablecoin lending market, I should say, etc. And over time, any smart contract on the chain. We thought a lot about the way that we built our tokenomics because I think that as mercenary farmers, as market participants in the past few years, we've seen common attitudes towards governance tokens, which is farm it and dump it. I think the vast majority of people do not care for governance tokens. I think the only way the governance tokens succeed or have value is if people can feasibly earn more revenue by holding them than by dumping them, right? And the VE model sometimes works in that direction when it comes to fee sharing and if you have enough fees being generated, but in many cases it actually just prolongs sell pressure and just turns into another vicious cycle where you get this classic like 5-layer triple TVL pie of I've got my DEX, I've got my VE token that earns shares for my DEX or earns fees for my DEX, I've got a liquid staked version of it, and then an aggregator for that, and then a bribe layer for the aggregator. we've seen this play so many times. I'm very much of the opinion that the only way to make governance work at scale and to make tokens like that valuable is if you can find a way to turn them into meaningful cash flowing assets, which I think has always been a little bit of a meme in DeFi, and perhaps the advent of RWAs will help move us in a direction in terms of having a sustainable yield. I think a lot of people are sort of doing that with LSDFi under the hood right now. But the way that works for Berachain and BGT is that basically people who are staking and holding BGT are actually earning a percentage of the fees from all the volume that's flowing through the DeFi primitives on the network. So the swaps, the liquidations on the perps, the interest rates on the lending market, et cetera. And also a form of the bribes that are actually being paid out to validators for protocols looking to bootstrap their own liquidity by directly giving incentives to a validator instead of doing a self-set-up liquidity mining program. So the way that gets really interesting, in my opinion, because when we think about where protocols want to go and when they look at their value across different chains, in most cases it comes down to cost of capital. So one of the things that we do, and we've talked to the Pendle guys a bunch about this and how we might be able to work together, is basically having validators work directly with protocols. Protocols give them X amount of their token, and in exchange gain Y amount of emissions in the form of the governance token of the chain, bootstrap their own liquidity from the ground up. Right? So I think stuff like that actually allows a governance token to gain value and perhaps a little bit more longevity in this incredibly mercenary, highly ADHD market that we're in.
Mm-hmm. No, I agree. I think so many of these protocols have these very long, often 5-year periods where the governance token gets dropped out over X emission, and maybe these emissions change. These emissions might be at the discretion of a voting DAO. But for the most part, it feels like the emissions are really the ones that are keeping the users versus a true product market fit. So I think that's just the opinion I personally have. And for Drift, we don't have a token yet, so that's why I'm asking these panelists for insights for how we might do things. With that in mind, we've talked about primitives a bunch. I think Smokey, you mentioned that the only way to earn that token is by doing work. And I want to draw everyone back to Wi-Fi. The only way you could get Wi-Fi was by mining it. I think that enabled it to just grow so fast. I think it's still one of the fastest growing tokens out there because there was no advantage for getting it earlier or paying or being a VC or in private rounds. It was all sort of level playing field. Anyone could mine it, and I think that really set the tone. So with things like Wi-Fi, are we seeing the model reverting back to earning these tokens through work versus payment? And does that make more sense, and is that more sustainable?
I miss DeFi summer, but yeah, I hope so.
I'm not so sure about that model because I think, it worked in the beginning, but gradually, because the proportion of token that a liquidity provider is rewarded is quite tied to the share in the pool, right? So if you are a big whale, you have a big share in the pool, and then naturally the tokens you will accrue most of the tokens in the pool versus a much smaller liquidity provider. So I don't think it is that fair anymore. And there will probably be some innovation around this form of token issuance, but I think that model that Wi-Fi partnered probably wouldn't work out as well.
No, I agree. It's kind of like the rich get richer, right? Where you have the bigger bag and you have a lot more to work with, and by default you have more of the chain. So I'm glad you brought this sort of more contrarian stance. So in the time that we have left, I know we've got about just under 5 minutes on the clock. Last series of questions are going to be focused on more forward-looking. So on new primitives, we've seen Uni V2 be a new primitive for AMMs. We've seen GMX GLP be a new primitive for how a derivative virtual AMMs work. What is a primitive or a model of primitives that any of the panelists are looking forward to seeing implemented? And feel free just to stick your hand up and take it as you go.
For me, I think, so again, going back to the previous point I made, which is all the past crypto history has since 2020, right, has always been governance tokens. So all the primitives that you mentioned also are for governance tokens, right? Like Uniswap V3 is very good for trading governance token because all these governance tokens are not, accessible on centralized exchange because it may be too new or, not past that criteria, right? And same for GLP too. So I feel like if we have a view that a lot of the new money in crypto is going to be through RWAs, which is, not governance tokens, right? So given that that's the fundamental, element or base layer as a token in crypto, then I think a lot of the new primitive will be how do you actually like combine different mechanics in DeFi to actually build applications that actually make sense for RWAs. Like yield tokenization is one step, right? But what else? Because I'm pretty sure a lot of the people in the next bull, when they come in through RWAs, they're not just going to be happy with 4 or 5% because they can also do that on their banks or something, right? If they have access to. So apart from accessibility, what else can they get? They're probably going to be hoping for, hey, how do we actually maximize RWA yields as much as possible that like real world cannot do? So I think that's with that like mindset in place. So I think there are going to be a lot of new primitives that we haven't even seen in the past. So it's not going to be like different versions of AMM. It's not going to be anything of those because like base tokens like RWAs are just so completely different than governance tokens. So that's my view, and that's also what Stella is building. We're applying the two main things that we think are really, really important. One is being leveraged. One is RWAs and how the new money is coming in. And how do we actually like engineer ways such that we can maximize the RWA yields through leverage that actually makes sense, but not too, I would say, short term like what in DeFi summer that we've seen. Yeah.
No, I think that's an excellent segmentation of how you think about it. It's like frankly two different assets, and they should be treated differently as such.
Yeah.
Ian?
Well, I am very much looking forward to restaking. I think restaking will revitalize that interest in LSDFi because it basically is a much more capital efficient means for ensuring the security of the underlying chain and also just liquidity provision. So yeah, we've had a pretty good run with LSDs in the first half of the year. Now there seems to be a shift towards RWA in crypto from a like sentiment standpoint, but I think in the next quarter or two with restaking, I think that focus will come back to LSDs.
Excellent. And Smokey?
Yeah, I think a couple of the angles I mentioned earlier are very much in play. So effectively, when I think about why people are on chain, in many cases it's access to an inefficient market or easy speculation. In other cases, easy access to leverage. I think the whole account-based collateral thing can be very interesting there. I think on the other hand, on the opposite end of the spectrum, one of the things I'm most excited about is innovations when it comes to smart contract security, and even though it's kind of a bad word, insurance. Because when we think about the trillions of dollars of assets that are sort of mandated to be deployed into DeFi over time from large fund managers, et cetera, or I should say the large groups that have 1 to 2% of AUM meant to be deployed into DeFi, in the most case, they're scared of smart contracts. They don't want to stake with Lido. They don't want to use Curve. They've seen everything and they've been burned lots of times. I think interesting new technical solutions and also to some exterior game theory / mechanism design that allows us to, I'd say, have better on-chain experiences from a safety point of view will go quite a long way. And I think there's groups that are doing really interesting stuff in that space in terms of basically front-running exploits and or having longer settlement times to which a chain can be rolled back and reset such that it serves as a proverbial sandbox, which can allow those sorts of groups to actually deploy the capital needed to make things like Pendle and so on and so forth very exciting in an on-chain world, right? I think RWAs will be very cool, and I'm excited to see what happens there, especially from a composability point of view, because I think most people, if they're not seeing sort of mid-teens, low 20s yield, will just simply happily sit and stake ETH or go to treasuries, right? They need to have some degree of risk and reward there. And I think finally, especially with an eye towards what we're doing, I'm very excited about what can be achieved within validator protocol interactions from both the capital efficiency point of view and sort of a governance and incentive alignment point of view at the chain protocol level, such that it can actually support the applications building on top of it, as opposed to just being, a parasitic object.
Excellent. I know we're just about to run out of time. Smokey, I have to ask you this for the entertainment of the audience. Are we in a bear market?
Some would say we're in a bear market. I would actually say we're in a Bera market. That's all I got.
Nice.
All right. So before we wrap, Panelists, how does anyone in the audience get in contact with you? Tascha?
Yeah, so I'm pretty active on Twitter. So it's my first name, Tascha_pan, like the two pans that you cook with. So that's me on Twitter.
For me, it's Twitter as well. TN_Pendle.
Smokey?
Yeah, no surprise. Twitter, Smokey the Bera on Twitter.
And for me, it's just David J. Liu, just my name. And with that, that's all the time we have. Audience, thank you so much. And please give our panelists a big round of applause.